The following program is paid for by EG Tax. All opinions or statements expressed on this program are solely those of EG Tax or its guests and do not reflect the opinions of News Radio 930 WBEN or Odyssey. The following program has been pre-recorded and is paid programming. It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hi, I'm Esther Gulius, the tax lady from EG Tax, and we're here to make sure that you are getting ready to make sure that the 2024 tax return is the best one that you can create. So that's part of what we do. We keep you abreast of what has happened and what's in the works to happen, so that when you're figuring out your finances that you don't overpay your taxes. And of course, I'm joined in studio with Christopher Fabian. Hey, Chris, how you doing?
Hello, Esther.
Hello, Christopher. Okay, happy Mother's Day to me.
Yes, happy Mother's Day to you and every mother out there,
Right.
or fathers who are mothers as well. So, because there are single fathers out there too.
Confusing. That's confusing. You mean fathers that are in the role of mothers?
Correct.
Okay, but and I guess that's true. So, but a happy Mother's Day. It's families can be very unique, and so a lot of times you think that some mother's supposed to be somebody that makes doilies and the best food in the whole wide world, and maybe a lot of those are true. But then there's a lot of moms that are working 2 and 3 jobs to keep food on the table for their kids, and maybe they're not as nurturing as the kids would like them to be, but they're hardworking. And so you just want to say thank you to those moms as well.
Right.
Right.
I know, like looking at my daughters and their friends, and why don't we have the perfect life like everybody else that everybody else sees? And you say, nobody's life is perfect.
That's
There's always
for sure. If you really dig down deep, But no matter what, I hope that if there's an issue between you and your mom, that you would forgive her, she'd forgive you, and have an opportunity to make amends this weekend. Mother's Day
exactly.
weekend,
Yes.
right?
Yes.
Anyway, I'm Esther Gulius, the tax lady from EG Tax. We're going to talk today. We're not taking phone calls. We're just chewing up emails that we got, which makes things very interesting because you can hear the way the tax law is written. It's always not easy. It starts off with this big law, and then it has all these little tentacles like an octopus. So we hope that you'll find listening to the emails interesting. And if you're somebody that has a question and you email us, you may find that we're using your email on one of our other shows. We do this 2-3 times a year, right?
Correct. Yes.
All right. So, Christopher, take it away. What do we got for emails?
Okay. I want EG Tax. I want to take advantage of the credits for home improvement. I have just finished my kitchen, and I know it qualifies for capital improvement. How much of it can I write off? It cost nearly $35,000, and I purchased all Energy Star appliances. Tony in Cheektowaga.
Poor Tony.
Yeah.
Poor Tony. All right, so this is a very common thing where people come in with that certificate of capital improvement, and they think, therefore, I get to take it as a tax write-off. But that's not true, is it?
No. That just means you don't pay.
So the certificate of capital improvement means what, Chris?
You just don't pay sales tax. So it's a nice thing because you save if you're in Erie County, 8.75, Niagara County, the 8%, but it does not help you on your taxes.
Right. So, but that doesn't mean that part of your kitchen wouldn't qualify. In other words, the fact that you have you're remodeling your house and people go, but it's my house and I'm making it better. The first reason that it's not deductible is the gain when you finally do sell that house, up to $500,000 if you're filing a joint return, or $250,000 if you're single, is going to be tax-free. So they're not interested in helping you to save any money because you're not going to pay any money anyway. So that's number one. Capital improvement means you don't pay the sales tax. But if part of your remodel included energy conservation, then that might help. Now, that's where they're going to say, well, how about the appliances?
Yep, and I always tell my clients that it's stuff that has to stay in the house that you can't take with you, like a stove and a refrigerator, a washer and a dryer. You can take with you. You may not, but you can pull it out of the house.
In other words, it's mobile.
Correct. Yep,
And so if it's mobile and it's Energy Star, it doesn't qualify.
correct. Yes.
So what does qualify is, now let's say you're remodeling your kitchen and you replaced several exterior windows. Then that's different, right?
Right. The windows count.
Potentially different
Yep.
anyway.
Yes, because then the windows, if they're energy efficient windows, do qualify, and you get to use that, and you can get up to a $600 credit for the windows.
Right. And if you put, and let's say to get into the kitchen, you have a exterior door that you put on that's also Energy Star. That door would also qualify, right?
Correct.
So your exterior windows would qualify, your exterior doors would qualify if they're all high efficiency Energy Star products, but the kitchen itself would not qualify. Even though it's a capital improvement, it means you just didn't have to pay sales tax.
Right. So your
And
cabinets.
I bet you it's a beautiful kitchen.
Yes.
So,
For sure.
all right, what else we got?
Okay, well, here we go for Mother's Day. Esther, my mother always taught me to pay myself first, so I have always been putting the maximum into my 401k. Can I still put money into my IRA? Steve.
Well, I mean, it all depends. If your employer has provided you with a pension plan that you're participating in, which is the case, and your income is lower, like usually under $75,000 if you're single, then you can also make a contribution to an IRA. However, if your income exceeds that threshold amount, then you can no longer put money into a deductible IRA.
Right. You may not get the immediate effect that you think you're going to get.
Right. So there's almost every credit or deduction where it's going to save you money has these income phaser outers. That's not a good word, phaser outer. But when your income gets higher, you start to phase out of the deduction. And so that's the situation with IRAs, American Opportunity Tax Credits, child tax, everything starts to phase out when you're an upper income person. And even though you don't feel like you're upper income, they say you're upper income and you don't qualify for the credit. You're going to find most credits are really geared to people that are moderate to lower income, and people that are moderate high to high income. Good luck. Hang on to your knickers, especially with what they're proposing here.
Yeah, what's interesting is for a traditional IRA, if your income is too high, it becomes a non-deductible. You use Form 8606. But a Roth, if you make over $210,000 roughly, you can't contribute, and if you did,
Anymore.
you get penalized.
Right.
You would think there would be like almost vice versa, the way the government wants people to put money in Roths so they get their money up front. But,
But if you think about it, because it's never going to be taxed, there's, and it's really not sheltering any income, any wages,
Yep.
So, okay, I think we're close on time here for a break, right, Chris?
Correct. Yes.
All right. Well, I'm Esther Gulius, the tax lady from EG Tax with Christopher Fabian. Tiffany is getting ready for Mother's Day, so she didn't come in today to do the show. But we're going to take a short break. We will be back with your emails on the other side.
This program is paid for by EG Tax.
Hi, I'm Esther Gulius, the tax lady. Thanks for listening to Ask the Tax Lady. If you need questions answered during the week and you don't want to wait till Saturday to call us, you can go to our website at egtax.com and ask the tax lady. Happy to help you with any situation. By the way, if you're getting any love letters from the federal government or the state of New York, kind of they're demanding money. It looks like they're demanding money, and whether we did your return or not, you want to make sure you stop in, drop it off, call us so that we can double check what they're proposing. Many times, if not most times, those proposals are incorrect or partially incorrect, and we can fix it for you and get you out of hot water. And if you've gotten a letter that says, prove your identity, that's the only thing that we really can't help you with directly, because they will not talk to us. They absolutely have to talk to you, the taxpayer. Now, we can help you because they ask you tax-related questions, and many times people don't know that answer. So we can sit there and point things out to you, but you have to be the person talking to the IRS. And so if you're getting those letters, it's not a scam. It's absolutely what you have to do if you want your return processed.
Right. I mean, we've had people, we've helped them make appointments in Buffalo because they can't verify themselves online. Just trying to get them in. The hard part is calling the number that's on these letters and getting.
Or either that or you're on hold forever.
I'm so sorry. We're too busy to take your call at this time. Click. But you got to do it because it will hold up your refunds for years until you get it done.
For years, right? Yeah, for years. So it's very important. So if you're getting letters with proposed tax changes, give us a call. We can help to sort out that. If your identity is being checked, we also can help you with that. We cannot make the call, but we can go through the tax practitioner hotline.
Right. Yep. And
then they hang up on you. Right. I mean, it's really it's frustrating for us too.
Yes.
I mean, I get it's got to be more frustrating to you as the taxpayer, but it's really frustrating to us because you get to you think you're really going to make it, and then they hang up.
Right. And, and people think we have a magic button to get in touch with them. And it's great. I don't want to say it's great, but it's nice when they hear that we get hung up on, or we have an hour and a half wait. We have, because then they understand our frustration is just as equal as theirs, because we want to help and we can't because.
But in the meantime, the other thing, the other day I had a taxpayer that hadn't gotten his refund from 2021. We finally got somebody who said, well, I have to tell you the truth. We don't have the tax return. Oh. So it was a paper return because it had rejected because of identity theft. And so they mailed in a paper return. And actually, this is a non-client of ours, so I just am helping somebody with a problem. And so then when we found out they don't have it, because that was during COVID, and they were so backlogged that some of these returns got lost. So if you're somebody that submitted a paper return and you still haven't gotten your refund, you might want to resubmit that tax return. Send it certified mail.
Right.
Or if it wasn't rejected, we can do it electronically.
Right. And a nice, sort of a nice tool is that on the IRS's website, Where's My Refund? It does actually go back for 3 years. Multiple years. So if you did send one in paper, you can go there, see, at least see.
And it goes, no information. That's a good clue that they don't have it, and resubmit.
Exactly.
Okay. All right. Now we're not taking your phone calls today. By the way, happy Mother's Day. My mom passed away about 4 years ago. And Chris, your mom is still alive.
My mom's still kicking.
Your mom is
She's
a
doing
wonderful
good.
lady.
Yep.
And your mother-in-law is a really wonderful lady.
Yes, she is. She's
Okay, and we're doing emails today. So you got another one here for us?
We do. Aaron writes in, my credit is horrible. I can't get ahead. My job pays around $60,000 per year. It's not enough to get out of debt. I use one charge card to pay another each month, and now that's coming to an end. You say you can help with budgets. Mine is really is a challenge since I owe over $20,000 in credit cards.
Okay, so we do help with budgets, and you know, part of the federal government's batch of laws is to help people that have gotten over their head financially, and that's called bankruptcy. If you have your debt forgiven while going through a credit helper, an agency that helps you with credit, and they have those debts forgiven, those debts can end up being taxable income, because when a debt is forgiven, it's potentially taxable income unless you're insolvent. Well, if you're insolvent, that means that you'd qualify for a bankruptcy. Many times people say, I don't want to do a bankruptcy, it's going to ruin my credit. I got news for you. Your credit's already ruined. And it's not like I'm advocating that you should go bankrupt, but bankruptcy gives you an opportunity to get a fresh start. And if you use that wisely, you know, and I've told this story before. My sister had cancer, and she was about $500,000 in debt because of her medication. Thankfully to God, her cancer was healed, and she never did die of cancer. She ultimately died about 45 years later of something else. But the thing is, she and her husband would never declare bankruptcy, so they could never, it was like dragging along a dead body. They were never going to get rid of the debt, and I kept saying, do a bankruptcy. Well, they finally did a bankruptcy. 2 years later, they had a house, they had a brand new car, they had a boat, they were saving money, and the whole thing all changed for them. I can just tell you that when we take a look at your budget, and we take a look at, unless you're doing something stupid like going to the casino every weekend and losing $1,000, if you're really between a rock and a hard place and you made some bad decisions and you're willing to change, a bankruptcy might be something that you want to look at.
Right. And, you know, we do have our summer series. We'll have Dennis Kitchen again on, where you can talk to him about bankruptcies.
And it's not like he's a schnook and he's really trying to shaft creditors. That's not it. The thing is, our federal laws are written in such a way to give you an opportunity to start from scratch. And bad credit that never gets resolved is as bad as a bankruptcy. But at least in a bankruptcy, it's over. Right? I
Yes.
mean, the day after you're bankrupt, now you have an opportunity to rebuild your credit.
Right. And the IRS has an option too for
There you go, Chris.
If you owe them money and you can't get out behind the 8 ball with the IRS, they do have offer and compromises where you do hear those ads, pennies on the dollar. They
And
do.
fresh start,
Yep,
right?
they do that.
And we do that.
And we help you with that. Yep.
Right.
You know, use the tools out there to take advantage to help you, but then you have to make the steps going forward and not fall behind again.
Right. You know the old adage, to continue to do what you're doing, you're going to continue to get what you got. So if you're there with a bunch of debt and you can't get out from under and you don't change what you're doing, you're just going to keep having bad credit.
Yes.
But if you should take that option to explore a bankruptcy, which may be the best thing for you, it's not for everybody, but it might be the best thing for you, then you have a brand new opportunity to rebuild your credit. But if you keep doing things the way you're doing it, you're going to continue to get what you got.
Exactly.
Right?
Yes.
Okay. We got time for one more?
Sure. Let's see. We got, after I filed my taxes, I received a K-1 in the mail. First of all, what is that? And do I have to do anything with it? If so, what do I do? And
K1 is kind of like a W-2 for a partnership, 1120S, a corporation, for an investment club where you might be a partner. So this is their way of reporting to the federal government that, this person got this money, and you better look on their tax return.
Right. It's your share of the profit or loss.
Right.
From your and because it's a form of an investment for easy sake. But
Right.
I mean, we've seen people who have them from TD Ameritrade. and they have no idea. Well, they bought into like an energy business type thing. But like you said, it could be a partnership. But if it's something you're not aware of, you got to really look to see what it is. Because
Right. Yeah. And but here's another thing. Sometimes if you have IRAs, your broker might buy into a limited liability company under your IRA, and they send you a K1. But that kind of K1 doesn't need to be dealt with, does it, Chris?
No, because it's not in your social.
It's in the IRA. And so anything that happens inside the IRA does not have to be reported until you start to take a withdrawal. So it's really important when you're looking at your K1 to make sure, especially if you say, I don't know what this could be from. Many times it's an IRA that your broker did and you weren't aware of it.
Right. So, but know your investments, know what's going on.
Right.
Let us.
All right. I'm Esther Golias, the tax lady from EG Tax. We're going to take a short break for the news. We'll be back on the other side with your comments and your emails.
This program is paid for by EG Tax.
Hi, I'm Esther Golias, the tax lady from EG Tax. Happy Mother's Day to everybody who's a mom. And here's hoping that you have a wonderful day. And if you're having problems with your kids, don't take it personally, because it happens in families. I'll tell you, it does. Anyway, I'm joined in studio with Chris Fabian, who happens to be my son-in-law, and I'm his mother-in-law. Can you imagine? What a burden. Really, Chris, it is a burden.
No, not at all.
Oh, that's so nice. I'm so glad you lied. Okay. We're talking about your email. So we got another one?
We do. Richard writes in, I just bought a vacation rental property in Florida. Our plan is to move there upon retirement in 5 years. In the meantime, we will rent it out. Right now, my wife and I make around $140,000 annually. This house in Florida costs over $500,000, and the HOA fees run another $600 per month. The insurance isn't cheap either. That's another $6,000 per year. We think we can get around $4,000 during season for 4 months and maybe $2,000 for the rest of the year. How much of the shortfall can we write off?
Okay. You want to tell them the bad news?
Well, because of their income, there may not be a write-off because you're right there. I mean, the threshold is $150. So very little of your loss would be deductible. It does, if say you lost $5,000, you may only be able to claim $1,000. That other $4,000 just goes out in the cloud. It becomes a rainy day loss, where if your income drops and you still have it as a rental property, you'd be able to use it. Or if you sell it before you may not end up moving down there. You sell it, you'll be able to use it. So
Okay, so in other words, because once your income hits 100,000, then between 100 and 150, you start to lose $2 for every dollar that you exceed $100,000 in allowable losses. So in your situation, let's say that you have a $10,000 loss. Well, because your income is so close to the 150,000, you only have maybe 10,000 of that loss that's going to be deductible, and the rest of it is suspended, like Chris says, until you sell the property. So many times when people are buying these second homes, they're not even aware, and let's face it, they have the income to do it, right?
Yep.
But because they have the income to do it, they're not allowed the losses.
Right, yep.
So you know, if this is something that you needed to use to help save money on your income tax, then it's not going to save you too much.
No, don't.
You better raise your rent at your second home.
Yeah, and hopefully that means $2,000 a month for the rest of the year, and not just $2,000 for the whole other 8 months, because then you're really behind the 8 ball.
Right. So that's, sometimes when I'm doing tax returns, and I don't know if you noticed last tax season, more and more families have income over 100,000.
Yep.
Did you notice that?
Yes.
And they're not just affluent families. I mean, this is what they're doing to just be able to stay ahead of the whatever, the Grim Reaper kind of thing. And so at 100,000, you start to lose your deductible expenses when you have rental property. So it's something that you want to make sure before you buy. If you're going to buy a second home and you needed that to use the losses to reduce your tax liability, you're thinking along that lines, give us a call because we'll map it all out for you.
And one thing is too, a rental property, the government says you have to run it like a business.
Absolutely.
So for Richard here, I mean, his rent would be very small, 16 plus another 12, we'll say. That's 28,000. His expenses, I'm assuming he probably has a mortgage and the property taxes too, are almost $50,000 probably. So is he really running it like a business by having a $19,000 loss?
Well, but here's the thing. In Florida, property values are so high. I mean, rents are very high during season, but during off season, good luck,
Right. And
so that's kind of the conundrum.
And let's throw this monkey wrench into it. And that's why we love these shows. We can do this. What if they use it for 2 months out of the year?
Then it's a really big problem because then they're really not allowed the loss. They can only take expenses up to their income and they won't have any losses at all.
Correct.
Because you can only use it 14 days personally and have it retain its business nature.
Right. Yep. Yes.
All right. What else we got here, Chris?
Let's see. We have my company is relocating to St. Louis. I am making the move as well. Is any of the moving expenses deductible on my return? Thomas.
This is very easy. No. How's that?
Yeah.
It used to be, and military reservists can take moving expenses, but nobody else can.
On the federal.
If you were moving into New York State, we would be telling you something different because into New York State would mean that you'd be able to take the moving expenses, but not if you're leaving.
Right, because you get to take it on the New York return. So the federal is very limited. It is, like you said, only the military gets it, which would be interesting because most of the time the military pays for the move anyways. So I think they were trying to be, look, we're still nice to our military. But yeah, unfortunately, that's not, and
So there were a lot of expenses that used to be deductible prior to Trump. And by the way, the Trump tax laws are all sunsetting in 2025, which means that they're going to rewrite the whole thing.
Maybe.
Oh, yeah, well, they can re-up several things, but I think that they are going to. I know that some of the things that President Biden is proposing is that the taxes that you would pay if you're an upper income person on capital gains is 44%. Well, the state of New York is another 8%, so you pay 52% on capital gains. So let's hope that doesn't go through.
Right. And I know one of my...
But they are looking for money.
Right.
Don't kid yourself.
Right now they say it's just the upper class, the top class. But, sometimes in those tax laws, we see it all the time. There's little hidden things in there that impact everybody.
Right.
So they may say, oh, well, right now, if you're in the 12% bracket and lower, that's what the law is, you're at 0%. Well, what if they just say it's only the 10% bracket that qualify? That could be written in that law, too. That means there's a lot of other people that now would have to pay tax on their capital gains.
Well, how about this, though? Let's say that you're a real average kind of guy, lady, making maybe $40,000, and you have a house that you're left, and they didn't do a life estate, and the house sells for $400,000. Guess who's going to pay a gigantic tax bill? You are.
Yep.
So just because right now this is how, but once you have that asset that sells, which is a capital asset, you might end up finding out that it just is a real expensive thing.
Right. And I know, like, in the infrastructure bill a couple years ago, which I can't believe nobody really talked about this except for us, how about they wanted to tax Roths?
Yep.
And could you imagine how people would have reacted if all of a sudden when we did their return, we would have said, oh, well, how much is your Roth worth now and how much was it worth? Okay, so all that appreciation you got to pay tax on now. What? They would have had a fit. But that's what they do with all these laws.
Well, you really have to, I guess that's what's so wonderful about our show is whatever they're proposing, we're going to let you know so that you're aware of it. And hopefully you would call your representative or senator and say, wait a minute, I don't like that.
Yeah. Yep.
Oh, we got something else here?
Sure. I filed an extension this year, and I have until October to finish it, but I owe around $3,000. Will they still penalize me? What should I do? Anthony.
Okay, so remember there's failure to file penalties, failure to pay penalties, and interest on the whole mess. So because he filed an extension, he's not going to have a failure to file penalty.
Right.
But he is going to have a failure to pay penalty. The failure to pay penalty is 0.5% per month until it gets to 25%. So if he waits till October 6 months, he's going to end up with a 3%, right?
Yep.
3% plus the interest. So the way to get out from under it is to just send your liability in now, because every day from April the 15th, when it was due, till you pay it, that's where the penalty accumulates. And so if you want to reduce your failure to pay penalty, just pay your liability.
Right. If you think you owe it, then pay it. I mean, if you overpay it, then
They're
you'll
going to give you it back.
You're going to get a refund. Exactly. So, but, and that's what we'll help you with. We'll take the time, explain things to you and go over things. And I mean, especially just because you have till October 15th to file, should they actually wait till October 15th?
No, I mean, obviously, if you got the money, get rid of the debt, because then you'll get rid of the penalty and interest.
Right.
At least on that much.
If you got your information, don't wait. Get the return done so there's no hidden surprises.
Right. Okay, we got a quick one here before our break.
Very hard to pick out a quick one real fast, but we could go a little bit over.
I have one.
Okay.
Okay. I can get 5% on a CD on $100,000 or $5,500, but will I have to pay it all back in taxes? Isn't that kind of a common thread that people think? People think that you actually pay 100% of income that you derive, but that's not true. It's a percentage bracket that you pay based upon what threshold you're in, right?
Right.
So
right.
if this person, for instance, is in the 20% bracket, it is true it's going to cost them $1,100 in taxes, but guess who made $4,400 that they wouldn't have made before?
Right.
And so whenever you have the opportunity to make money,
Make it.
except for this thing that they're proposing with capital gains, which would be 52%. But under current tax law, make the money.
Right. I mean, and we get that all. Oh, should I work overtime? Should I not? I don't want to jump
Make
tax
the
brackets. Make the money. You'll
Make the
never
money.
pay more than
you
your
make.
make. And
Right.
that's what,
Right.
we try to tell people all the time.
All right, I'm Esther Gulius, the tax lady from EG Tax. We're taking emails for you. Happy Mother's Day. We're going to take a short break, and we'll be back on the other side.
This program is paid for by EG Tax.
Hi, I'm Esther Gullius, the tax lady from EG Tax. If you are stuck with a bill from the IRS or state of New York and you don't know what to do with it, give EG Tax a call. If they want to prove your identity, we can help, but we can't make the call for you because they want to make sure they talk to you. I mean, the important thing is if it's a tax issue, EG Tax will help. Chris, I mean, even a great family member of yours had their identity checked here. Not long
yes,
ago.
yes, yep. Well, both of my daughters did between last year and this year, so it's not something we did because I wouldn't do that to my daughters. But everybody who's getting a refund basically is getting these letters. That's what I've noticed. They're not going after people with balance dues
Well,
because
that's true, isn't it?
you're not going to file a fake return saying, "Hey, I owe you money."
Yeah, right. But the thing is, if you have an identity letter that they want to identify you, you have to do it. If you don't do it, they're not going to process your return. So you may have a balance due this year, but next year they're going to come. They won't process your refund. So you want to make sure that you do that. If you need help, give EG Tax a call. We want to help. And today we are kind of chewing up your emails. And again, happy Mother's Day. I'm Esther Gullius, the tax lady, and Christopher Fabian, the tax person, man, gentleman, son-in-law. All right, and we have other questions.
Yeah,
right?
but I just to feed off what we were just saying, isn't that another reason for identity theft not to have a refund?
Of course.
So you don't have to deal with that. I mean, it is.
See, the thing is, the money that comes to you every year that in the form of a refund, unless it's due to an earned income credit or American Opportunity Tax Credit, a refundable child tax credit, it's really your own money that you're getting back. And so what Chris is saying is change it so that you don't get a big refund, so that that nobody holds up your refund, because get it as you earn it, so that you can get 100% that's of your income to pay your bills, so that you don't go into debt.
Yes.
Okay, what do we got here?
We got Carl and Michelle write in. EG Tax. My neighbor told me that they give money to their church through their IRA and it saves them money on their tax return. Is this something we can do? Will it save us money as well?
Maybe. First of all, you have to be someone that has to do a required minimum distribution. That's number one. Number two, it has to be out of an individual retirement account. Okay? But if you are somebody that would give money to charity, and you have a required minimum distribution, and it's out of an IRA, and it's less than $100,000, then the money that you give through your qualified charitable deduction is going to be tax-free on the federal, and you can then bless your charity with your contribution, and they get the money as well. So let's say that you have an RMD of $20,000, and you're somebody that gives money, and let's say you're 75. Let's say you give $20,000 a year to your church, then you would do a qualified charitable deduction, and they would take that money from your IRA and give it directly to the church. It would be completely tax-free to you.
Right. And well, let's just go a little bit further and say, you have somebody who has a single person has a pension of $20,000, Social Security of $20,000, and then their RMD would have to be $15,000. I mean, not only would the $15,000 from their RMD be tax-free if they're giving it all to charity, but then their Social Security would not be as taxed as much as it would, so it's double saving them money.
Right.
And with
I mean, that's why so many of these laws are dependent upon another part of tax law, and so it just makes so when you're doing planning, you have to make sure that you got all your bases covered.
Right. And with the high standard deduction, so a single person over 65, that's about $15,300 roughly.
Right.
If they don't have a mortgage on their house anymore, they pay property taxes of $6,000, and they give $4,000 to charity. Is that charity deduction going to help them?
Nope.
No.
But it would if they did a QCD.
Right. So it's not where we, in the beginning of this, we were talking given $15,000, given $100,000. It's not just, it's any amount could help you.
Yep.
So something to look into.
I mean, the important thing is, if you want to sit down with EG Tax, we do not charge anything for a consultation, and we can show you what's available to you.
Yes, definitely. We want to help you.
We do. We certainly do. I mean, like we always say, to us, your family.
Correct.
All right, what do we got here?
My husband left our family home last year in February. I have 3 children under age 10. I'm living on public assistance since he is nowhere to be found. Are there any situations I need to work for taxes? How can I file if he's gone from our home? Lorraine.
Okay, so this is one of those tax loopholes that not everybody can take advantage of, but here's the criteria. If your spouse is out of the home for the last 6 months, if you're still legally married, if you're maintaining the home for a dependent child under the age of 17, then you get to file as if you're head of the household. But if she has no wages, you have to have earned income. If she had earned income, then she would qualify for the earned income credit and the refundable child tax credit, right?
Right.
So I would say to Lorraine, it's Lorraine, right?
Yep.
You need to go get a job. And I know you must say, oh, I don't have time, I have 3 children. But it's the kind of thing that even if you took children into your home as a daycare person and you were self-employed, you would still qualify for the earned income credit.
Right.
So you really want to make sure you have earned income, a job, or self-employment. And if that's the case, well, you could get another $12,000 in refunds,
Right. I mean,
which would really help your financial situation.
Right. If all her kids are in school, get a teacher's aide job in their school. This way, you're only working when they're at school. You won't need a child care provider. So then you're making money. Your refund's going to double your money, basically. Hate to say that, but...
And remember, it's not only just the federal, it's on the state as well.
Yep.
So the worst thing that you can do is just stay without a job.
Yeah, I know.
I mean, even if she made $3,000, right?
Yep.
She'd end up with a $4,000 extra refund.
Yeah, I mean, I had a client this week. She just married somebody from Buffalo. She's from London, England. Jolly old England. And we were talking, and she goes, your tax laws are very confusing. I said, I know, I understand your tax laws. It's a flat 40%. And she goes, pretty much, yes. She goes, why don't you guys go to a flat rate like that? I said, well, people talk about it, but unfortunately, our tax system is a socialistic ways for people to. So I explained to her about the earned income credit and that. She goes, oh, yeah, that will not, a flat tax will never work.
Right. But here's the thing. If you make $50,000 and it's 40%, you would pay 20%, 40% of $50,000, which is $20,000 in taxes, right?
Right.
If you make $100,000, you pay $40,000 in taxes. But that means the person making $100,000 still has $60,000, but the person making $20,000 doesn't have that much money to live on. So that's where our system says, wait, we have to be fair. And so in their effort to be fair, they make it very complicated.
Yes.
All right, we got anything else here
Yep.
before?
Tanya writes in, with student loans starting up again, who claims the interest paid, me or my son? It is a parent plus loan.
Okay, what do you think, Chris?
Well, who's paying it? Are you paying it or is your son paying it? If you're paying it and your name is on it, you should claim it because you probably have a higher income, maybe, then your son, and it could.
But what if it's too high?
Then let your son claim the interest.
Right. That's right. Because if your income's too high, they're not going to let you take it at all.
Yep.
Right? So you got to really look at both situations. Now, let's say the son makes $12,000 and the mother makes $200,000. Who gets to claim it then?
Well, wait, say that one more time. Sorry.
The son makes $12,000 and the mother makes $200,000. Who gets to claim it?
Well, I still would give it to the son because the federal won't help, but New York State will get a
that's
little
true.
bit from
well,
New York
let's
State.
assuming that he's self-sufficient. He's
Yeah.
not. She's not claiming him.
Right.
That would help a little on New York State.
Yes.
Yeah, but on the federal it won't help at all.
Correct. Yes. But yeah, I mean, if I know we're running out of time in this show.
Yeah.
I mean, call us. We can't say that enough. Call us. We want to help you save money and do it right.
And go to our website, egtax.com, and if you're getting a love letter and your heart drops when you go to the mailbox, don't even open it. Just come on in. Right?
Yeah, don't throw it away. Don't ignore it.
Right. Until next week, I'm Esther Goulias, the tax lady from EG Tax. Our website is egtax.com. Happy Mother's Day. And again, Christopher Fabian is my right-hand guy here, and Tiffany is took the Saturday off. So until next week, I'm Esther Goulias, the tax lady. Talk to you later.
Happy Mother's Day.
The previous program was paid for by EG Tax.